People are leaving bonds because they realize that there's a very high probability of monetary debasement. Okay, fine. So you decide you're not going to own bonds, which is smart. That's the first step. Then you got to say, how am I going to protect myself? Do I own real estate? Do I own stocks? Or do I own hard money? And, up until now, stocks have done an okay job of protecting you because they're at record highs. So there's a certain number of people who say, I'll sell my bonds, I'll buy stocks. Well, I don't think that's a particularly good idea. And I think what's happening or going to happen is that as the economy rolls over and as the stock market starts to stumble a bit, more and more people are going to realize that the real cheap, undervalued asset out there right now is gold and the gold mining shares. And so, I fully expect the next couple of years are going to be just outstanding performance. I think everybody is still doubting this bull market in gold, which is a good sign. It's a wall of worry and no one believes in it. If everyone and their brother thought gold was going to the moon, as a contrarian, I'd be a little scared. You and I think it's going to the moon, but most people don't. Most analysts in the gold world are who write about gold are thinking that in 5 years, gold's price will be in the 2,100, 2,200 level. And I think both you and I would agree that it's likely to be 3, 4, 5, 6,000.
Lepard begins by addressing a critical issue, the artificial inflation of stock markets due to years of quantitative easing, zero interest rate policies, and more recently limited quantitative tightening. According to him, these policies have distorted financial markets, leading to what he describes as puffed-up valuations. Investors, conditioned to buy the dip, have become overly reliant on the so-called Fed put, a belief that the Federal Reserve will step in with aggressive stimulus whenever markets face a downturn. He reflects on March 2020 as a prime example, when Fed Chair Jerome Powell unleashed unprecedented liquidity to stabilize markets during the COVID-19 crash. This intervention, Lepard suggests, has created a dangerous expectation that any future crises will be met with similar action, potentially fueling further asset bubbles or a crack-up boom.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
The reason the stock market's as puffed up as it is because of all the free money distortions that occurred, from '08 until present, where, we had ZIRP for all those years and QE and so forth. We're in QT now, but, small QT. But yeah, it's a big distortion. And also, people have been trained to buy the dip. There really is a Fed put. We all kind of know that instinctively. In March of 2020, when things started to really fall apart in the COVID example, Powell came with a bazooka. and I think everybody expects that to happen again. And so to the degree that, I think the market is saying, well, nothing bad can happen because if we go down, they're going to bring a bazooka and we're going to, go on to new all-time highs, which is entirely possible if we have a crack-up boom. But, whether we do that or not, I don't really know. I can't predict what the Fed's going to do. However, I do think that when push comes to shove and the choice is either, print and keep the system going or let the system collapse as a result of, not printing. I think we know what they'll do, right? They will print. They always have. They will. And they have to. So, and that's the whole theme, the whole monetary debasement theme. And I think what's going on right now is there's kind of a tug of war. I think a lot of people know that the Fed's out of control and the government spending's out of control. And so that's why the bond market's not behaving particularly well. As you pointed out, rates should be coming down if the economy is slowing, which it appears to be. D.H. Horton just had terrible numbers this morning. So, that should be happening, but it's not. And I think it does go to what you pointed out as the creditworthiness, right? So, rates are going up. And so people are leaving bonds because they realize that there's a very high probability of monetary debasement. Okay, fine. So you decide you're not going to own bonds, which is smart. That's the first step. Then you got to say, how am I going to protect myself? Do I own real estate? Do I own stocks? Or do I own hard money? And, up until now, stocks have done an okay job of protecting you because they're at record highs. So there's a certain number of people who say, I'll sell my bonds, I'll buy stocks. Well, I don't think that's a particularly good idea. And I think what's happening or going to happen is that as the economy rolls over and as the stock market starts to stumble a bit, more and more people are going to realize that the real cheap, undervalued asset out there right now is gold and the gold mining shares. And so, I fully expect the next couple of years are going to be just outstanding performance in my fund and the stuff we own, the stuff you own, Arizona Metals, et cetera. I think it's going to blow people's socks off. And it's a tough category because, for years and years it stinks and it doesn't particularly do well when everything else is doing well. I mean, when everything's under control, the mining business is a tough business, not a good area to invest in. But when you have monetary debasement and the government's out of control and the economy's rolling over and the stock market's going down, as you know, because you've been around long enough, and I know this stuff does extraordinarily well. And so you look at the 70s, I mean, gold stocks went up 12x and it was 35-40% compound for a decade. And I think we're entering a decade like the 70s. So I'll stop there, but that's kind of, my view of what's going on. I think everybody's still doubting this bull market in gold, which is a good sign. It's a wall of worry and no one believes in it. If everyone and their brother thought gold was going to the moon, as a contrarian, I'd be a little scared. You and I think it's going to the moon, but most people don't. And, in my quarterly report, which is just out, we've got kind of the estimates, and I've seen the investment banking estimates as well. I mean, most analysts in the gold world are who write about gold are thinking that in 5 years, gold's price will be in the 2,100, 2,200 level. And I think both you and I would agree that it's likely to be 3, 4, 5, 6,000. So, but if they are right and the price does not appreciate like we expect it to, we do know that the mining costs are going up. The ASICs are increasing, average all-in sustaining cost are going up every year. And so, and in some cases radically. I mean, Newmont really messed up, and with their Newcrest purchase, and their ASICs went up enormously, 55% year on year. And so, but taking the more broad industry averages, they're climbing 7 to 10% a year. And if you do that for 5 years or 3 or 4 years, and then the price of gold doesn't go up, well, their margins get squeezed. But you're right, Peter. Today, the average gold company has got an ASIC of 13 or 1400. They're selling gold at 2700. I mean, that's one hell of a margin. That's a 50% plus gross margin coming out of the ground, and that's stunning. I mean, and so that leads to higher cash flows and so on and so forth. So, and I think eventually the market will come to realize this. But I started my career. You probably were similar. I started my career in the '80s, early '80s, and everyone loved gold, everyone loved oil, everyone loved inflation plays because inflation was never going away, and we all knew that because of the '70s and what had happened, and nobody wanted to buy stocks in '83 or '84. Stocks stunk, and bonds you didn't want to buy bonds. I mean, the 30-year was yielding like 11%. It was nuts. Because nobody trusted it, right? And of course, that was a good time to be buying it. And so, people tend to invest in the rearview mirror. And the rearview mirror is, stocks are great, and why do you need gold? Why do you need gold stocks? They haven't done that well. But I think things are shifting, and that's the important thing to understand, is that I think we've entered an inflationary world. It's not, these macro shifts don't occur every day. They don't occur every week. In fact, they don't occur every decade. But, when the Fed printed 42% of the money supply in a couple of years to deal with COVID, and then they left the government expenses at the same level, and so our deficits continue to grow, we're now in a situation where the government is trapped and they have to continue to print money and grow the money supply, or else this whole thing's going to collapse. And that's what the metals are responding to. That's why gold is at 2,700.
Lepard shares an interesting view on Bitcoin, positioning it as a modern form of digital scarcity. While some gold enthusiasts dismiss Bitcoin for being intangible, Lepard argues that money itself is just a ledger, a representation of value rather than something inherently physical. He compares Bitcoin's innovation to the invention of the printing press, which revolutionized the dissemination of knowledge. Bitcoin, in his view, is similarly groundbreaking because it introduces digital scarcity in a world where traditional money can be printed at will. As with gold, Bitcoin's limited supply makes it a compelling hedge against inflation and monetary debasement.
The bull market we've had right here is one for the ages, and it was really driven by the distortion I spoke about earlier, the ZIRP. I mean, when you make money free, why not borrow and go speculate in stocks? And that's what's happened. So it's not that complicated, but, sadly, somebody who's in their 30s or 40s, they think this is normal. And you and I both know this is not normal. But, and they're going to learn it, sadly, from their point of view. But, that's just the way things happen. And, I can't say when they're going to learn it though. I mean, I'm watching the stock market carefully, and I mean, smart guys who I respect, like David Hunter, think we've got another 3 to 6 months of blow off top. Trump wins, they cut rates, and everybody's happy, and we go on to higher highs, and that's entirely possible. I mean, I'm not short the stock market. Let me say that. And a lot of gold guys are against it, and I get that. It's not physical, it's not tangible, but I've always said money is just a ledger. Money, your dollars in your bank account aren't tangible either. They're just dollars. They're on a computer screen that you can see that tell you they're there. And so that's a bank ledger. And, money's a ledger in my view. It doesn't have to be tangible, but what it does have to be is scarce. You can't, the reason gold has value and has had value for 5,000 years is there's only so much of it, and it's hard to mine it. And what these guys did with Bitcoin is they created digital scarcity. That's the invention, digital scarcity. Think of it like somebody made a printing press, and before the printing press, everyone had to write books out by hand. You had monks that did it for a living. Printing press, boom, you got Bibles coming off the press. And so we've got a form of money that is represented by true immutable digital scarcity, which takes some time to get your head around and understand. But that being the case, you've got a ledger entry that can't be messed around with. There are only 21 million of them. And so what's going on is slowly but surely some portion of the population and the investing public is realizing, hey, other people believe this monetary unit has value, and it's scarce, and therefore I believe it has value too. And so they come and they buy it. And so you've got an adoption curve taking place on top of a fixed supply, a relatively fixed supply, and because it's still growing as we mine more coins, but ultimately it'll top out at 21 million coins. So you've got digital scarcity. And I just like to say that, gold is analog sound money and Bitcoin is digital sound money. And there's a place for both. And I have no problem with anybody who wants to be all gold, or no problem with anyone who wants to be all Bitcoin. And I know a lot of people who have a little bit of both, like me. So that's kind of the background pitch. And what I would encourage gold people to do is to try to approach it with an open mind. I mean, I know it's very frustrating being right about the investment macro thesis that gold represents. And then this new thing comes along and you got all these loudmouth people yelling how great it is. And, and there's been a lot of crypto hype and bullshit and fraud and promotion. I mean, guys like Sam Bankman-Fried, really did a disservice to the underlying theme and invention that Bitcoin is. And so people, I think, need to, I think it's worth taking the time to learn and understand it. And really the place to start is to read Safe's book, The Bitcoin Standard. So
Lepard concludes by stressing the importance of recognizing these macro shifts. While predicting the exact timing of market movements is difficult, he advises investors to prepare for an inflationary environment by moving away from bonds and into hard assets. The current rally in gold, he asserts, is only the beginning of a much larger trend, and those who act early will be well positioned to benefit. Lawrence Lepard offers a sobering perspective on the economic challenges that lie ahead. His message is clear. The era of easy money has created distortions that are unsustainable, and the Federal Reserve's only option is to continue printing money, leading to inflation and asset revaluation.
Please like and subscribe my channel.